Good afternoon, everyone, and welcome to Prestige Wealth Management Group's third quarter 2024 economic and financial markets update. On today's webcast, you're going to hear from Prestige's founder and CEO, Roy Williams, Senior Portfolio Manager, Paul Esposito, Wealth Advisor, John D'Angelo, and myself, Wealth Advisor, Michael Williams. Just a couple of housekeeping items. First and foremost, we cannot take any live questions during the webcast today, but if you do have any questions, please send them in to pwm@prestigewmg.com, and we'll be sure to get back to you. And secondly, we will be recording this webcast, so you will receive a link to re-watch the recording if you'd like, so be on the lookout for that. And with that, I'll pass it over to Paul Esposito to get us started.
Great. Thank you very much, Michael. Good day, everyone. The third quarter, it almost seems like at least the last few quarters, when we look at the equity and fixed income, well, at least for the equity market, it's been more like Groundhog's Day, where the markets continue to, climb this wall of worry. We get maybe some interim volatility related to, maybe a econometric reading that comes out, greater or less than anticipation. And then, of course, the market's been able to quickly absorb that and move forward. When we look at, equity markets, they certainly, grinded to, an all-time high or close to an all-time high toward the end of the quarter. Fixed income markets, on the other hand, gave back a little bit of their gains for the year, and that was really just due to a recalibration of expectations for what the Fed plans on doing with cutting interest rates for its last two meetings for the year in November post-election, along with the December 18th meeting. So, if you were to kind of estimate at the beginning of the year what the trajectory of the markets would look like, I'm certain, with that, most individuals would, in an election year, would probably figure there to be a lot more volatility and maybe a lot more retrenchment in the markets that we've seen thus far. So it's actually been, very interesting to digest, especially considering the fact that, we have seen some softness in, some of the leading economic indicators. Health of consumer has certainly come into question more over the last couple of quarters. And, is the growth that we've seen in the equity markets justified given, some of those prevailing concerns? So when we look at the state of the U.S. economy, chart to the left is the Index of Leading Economic Indicators, or LEI for short. It's 10 components, spans all the way from credit levels, S&P 500 index reading, the spread of the 10-year Treasury to 3-month Treasury, and then, of course, you've got, some components with labor, average weekly hours, building permits, and then there's some sentiment indicators when it comes to business expectations and consumer expectations built into that. And for the most part, if we look at September's numbers, that index of economic indicators has stagnated. And if you look at the chart to the left, it's on a year-over-year basis, we have still seen a decline, an overall decline. For September, most of that was attributed to new orders in manufacturing, a drop in building permits, and consumer expectations for business conditions declining, along with the rise in yields for September. And, that, of course, has put pressure on lending. So it's no surprise that we see that stagnation. The good news is if we compare it to 2023 level, it looks like maybe 2023 is where we saw a bottom there. And of course, that's, that is to be continued as we get those readings in subsequent quarters. But when we look at the overall economy and we look at, it's sort of bifurcated to manufacturing versus services, which is non-manufacturing. The manufacturing segment of the economy has been in contraction. I mean, for a very short period did it touch 50, which a reading above 50 shows expansion, reading below 50 shows contraction. But that dark blue line, if you look at the right-hand chart, has signified that manufacturing's been in a recession for the better part of, call it 2.5 years. Where the saving grace behind, the economy has been in the service sector, where although it is currently, touching that 50 line, but it is still showing that level of resilience. So we are keeping a lookout for those numbers. We want to make sure that we actually start to see a noticeable movement in the opposing direction for both of those. Now, how does this corroborate with the job market? When you look at the last few years and you look at payroll gains, from 2021, we saw record payroll gains, and a lot of that was due to the post-pandemic swing back of job recovery. There's a very interesting headline back in August. It's when the Bureau of Labor and Statistics revised job gains, and they did it for a one-year period from April 2023 to March of 2024. Apparently, the Bureau of Labor and Statistics decided, hey, we overstated jobs by 818,000. So this chart actually factors that in. So you are seeing a noticeable trend downward in payroll gains. Now, August payroll gains was 142,000. September's was actually a surprise of 225, I believe. We'll see if the BLS, of course, revises those down in subsequent months. But even with the revision that we saw, that 818,000 payroll revision downward, that's still, if you look at the rolling trend and even the 3-month average, that's sufficient enough to absorb the growth in the labor force, which is important, because if you can't do that, then the unemployment rate starts to spike, which is part of the reason why we have an unemployment rate ratcheted down closer to 4%, as opposed to somewhere around 5%, if we weren't getting positive payroll readings. Labor force participation, if we kind of shift gears there, and if you look at the left-hand panel where it shows total labor force, right now we're at 63%-ish or sub 63%. And that is still below pre-pandemic levels. So there's certainly potential for that to be recovered. But if we look at the 18 to 64 age bracket, and I think this is really what's been driving that overall trend, is that that participation rate is now healthily above pre-pandemic readings, and it's above 77%. And really what this is telling us is it's reinforcing the trend in the baby boomer retirement, because most of those 65 plus are certainly dropping off the labor force, which is part of the reason why the participation rate is, as not as high overall as to where it was back in 2018 or 2019. So if we kind of look at labor supply, and we look at the prime labor market, which is that 25 to 54 year segment, that is reinforces that's at an all-time high, just within the last, almost the last 15 years. And really what that's telling us is that, that segment of the labor market tends to offer more productivity and actually has a little bit more longevity in the workforce. So that is, of course, a very positive attribute of the current condition of the labor market. We look at initial jobless claims, on the other hand, They have started to trend downward. I mean, we did see them peak in, if we look at the last 3 years, back in 2023, of course, trended downward toward the end of 2023. We're back, down to that sub 225 for initial jobless claims. Again, well below that 2020, 2021 level. But it still reinforces the fact that the labor market is at least still intact, still healthy. But if we look at the overall health of the consumer, this is an area that we have, continued to watch, and that does give us a little bit of caution in the quarters ahead. The chart to the left is the U.S. debt service ratio. It's basically your debt service payments per household divided by that household's disposable income. Of course, it was at an all-time low when, the savings rate was high and there was a ton of stimulus money afforded to taxpayers back in 2020. But that debt service ratio has handsomely increased, and we're now back to where we were, well above the 2019 levels, almost close to 2016. Good news is it's not near the great financial crisis levels, and there probably is still a little bit of wiggle room for the consumer. But when we look at forms of debt that the average U.S. household holds, some concerning trends that we're seeing are in the credit card delinquencies. So if you look at the chart to the right, it's showing percentage of loan balances that are 90 days plus delinquent. The one that stands out is credit cards. Credit cards now, almost a little over 11% of all outstanding balances are 90 plus days delinquent. Other debt, that also factors in some other forms of non-revolving debt is also higher. The same goes for auto loans. Auto loans have crept back up. Of course, student loans, with some of the current administration's plans to defer student loan obligations or pay them off, that can certainly drop precipitously. With mortgage rates being at an all-time low, you of course saw, a couple of years back when rates were very low and individuals refinanced, that has afforded your average homeowner the ability to easily cover their mortgage. HELOCs, on the other hand, is a bit perplexing because rates have certainly gone up, but given the type of the collateral, right, you're still backing that with your home. Most individuals are going to be probably inclined to make those payments. But really what this is telling us, if you look at credit cards and autos, is that there is some stress that's permeating into the consumer. And this is also being reflected in business confidence and overall consumer confidence. So if you look at the small business capital expenditure plans, now it's still a positive reading because it's showing a percentage of small businesses that have plans to make capital expenditures within the upcoming year. It's still, more than 20%, but it's recovered from where we've seen prior contractionary readings in the economy. And then if you also look at private non-residential domestic investment, it's noticeably declined since 2020. Granted, 2020, with the influx of fiscal and monetary infusions into the economy, it was bound to be at a record level, but it's slowly waned. Consumer optimism, on the other hand, and if you also look at retail sales, those have stagnated as well. The retail sales, if you look at the retail segment in particular, I know at least for the second quarter, there were a lot of retailers that denoted that the consumer is tapped, or their concerns for the consumer given high interest rates and credit card balances. I think it was Dollar General Corp that, noted that their lower income consumers, when they reported their second quarter earnings, were showing signs of distress, and their purchasing was actually tapering off toward the end of the quarter or end of the month, because that aligns with, a lot of entitlement benefits with their spending patterns. So, we are keeping a watchful eye for those trends to hopefully reverse, but we do know that the overall health of the economy could certainly be impacted if those do worsen. But the underlying crux of, the overall business and consumer confidence being where they're at really has to do with, the inflationary issues that we've, been dealing with for the past 2 years. I think an interesting factoid, if you look at inflation just, over the last rolling 12 months compared to average hourly earnings, total inflation has been over 20%, whereas average household earnings has only been about 18%. So just over a rolling 12-month period, that was over a rolling 4-year period, I apologize, was at 20% for the CPI and 18%. So consumers over the last rolling 4-year period have essentially lost out a few percent on overall purchasing power. You look at the prior 4 years to that 2016 to 2020, inflation was running at 8% and average household earnings was running at 15%. So, we went from an environment where the consumer felt about 7% wealthier to an environment where the consumer now feels about 2% poorer. And so to discuss inflation a little bit more, I'm going to hand this off to Roy.
Speaking of inflation, you have to understand, you go to the grocery store, you're spending 20 to 30% more than what you were spending 3-4 years ago. So when you're looking at inflation, so a lot of people say, well, inflation really hasn't come down. Well, it's comparing year over year. It's not comparing from when, from 3-4 years ago when we had a huge spike of inflation. And what you're seeing is, for example, yesterday, gasoline was down on the wholesale market 4% and oil was down 5%. So, we've continued to see a drop and an increase of inventories of, gasoline and oil. So it's, that's definitely helping when you look at this chart and the makeup when we had high inflationary periods of, that we had in 21 and 22. You saw a big part of it was energy. So that's helping. But, going out to dinner, I was talking to a friend yesterday. You go out to a nice restaurant in Flemington, it can cost you $200, and you bring your own wine for a couple. So it's there has been significant inflation. I mean, some restaurants are adding service charges onto the bill of 4%, even if you're not paying by credit card, they're just adding service charges. So because they're feeling the bite also because of wage inflation for the restaurants and also the cost of food. You go to the grocery store, buy a steak. This weekend we had steak at Wegmans was for choice was $28.95 a pound for steak. So, and it's no different with other meats and vegetables, fresh vegetables. So, inflation is an issue, and hopefully as we go forward, it continues to subside as we go forward. But housing, because of low inventories, you're feeling in the housing sector. Rents, my daughter was looking at a 1 or 2 bedroom rental in the areas, $2,500 to $3,000 a month in a safe area in the Tri-County area, Hunter and Somerset counties and the Morris counties. It's it's been huge inflation in that space. So, and auto insurance also. I mean, you can see by the chart, it was benign. And now, you saw a significant increase. And I think part of it is the labor costs for the mechanics that, if you have an accident fixing cars, and also the cost of parts has gone up significantly. So, and this doesn't really, we're not even accounting for homeowners insurance. You think about the two hurricanes that hit Florida and the storm and this hurricane and the storms that hit North Carolina, South Carolina, Georgia, caused significant damage. And a bunch of it, because it was wind, is covered by insurance. So, who knows what's going to happen going forward with homeowners insurance from an inflationary standpoint. Housing, as we talked about, when we look at inventories are still very, very low overall. We're seeing in some areas, such as the condo market. I was talking to a client yesterday, who's thinking about buying a condo in Florida. The condo market, we've seen a spike in inventory because of what happened with the collapse of a tower and the cost of maintenance and insurance. I have a client I spoke to a couple of days ago, and he's paying $6,000 a quarter for a two-bedroom condo maintenance costs, which includes his insurance cost. So that's significant and impacts the cost of housing. So, interest rates also, as we see, with interest rates as high as they were, you can afford half the house you could afford in 2021 as you can afford today, with interest rates more than double where they were in October of 21, 3 years ago. So, affordability index, that's a challenge. If you have a young couple buying a house, their first home, for a lot of people, it's unaffordable. And so, again, it increases the demand for rentals. And also, a lot of people that have low mortgages are staying in their homes because to move, if you have a 3% mortgage, we're seeing clients withdraw money and do bathrooms. I met with a client this morning that just redid their bathroom. Doing kitchens, they're doing work on the existing house, adding a room here and there. So rather than move, because you can't get the mortgage that you have, you can't come close to that. So as interest rates come down, I think you'll have an expansion of inventory, and also you'll see these numbers improve as I think interest rates come down in the next 12 to 18 months. So, global inflation, you're seeing, throughout the world, if we look at Japan down to China, well, my opinion, it's tough to believe what numbers come out of China because I'm not always correct. But, leaving them out of it, I mean, you're looking at inflation numbers that have come down very significantly from where they were in 2022 across the globe. And, our hope is that this trend continues as we go forward. And you'll see it, again, gasoline has come down in the past couple of weeks. So you'll see that at the pump, you may be seeing $2.60 at the pump in New Jersey shortly. Pennsylvania may be $2.70 because, again, they have a higher gas tax. So it's, that's positive as you're looking throughout the world, having a lower inflation rate. And talking about the Fed, the Federal Reserve, the Federal Reserve expectations are that, hopefully this year we get another 0.25%. And, from this chart, you can see that, normally, the Fed will continue to decrease rates, going out 12 to 18 months. So, hopefully we get down to a, interest rate, overnight lending rate of 3.5%. Which most likely, will bring mortgages down, hopefully to, 5% or below. And I think that will definitely help the housing market, and you'll see an increase in sales. And this is looking at the likelihood of a rate cut, at the meeting after the election at 92%, having a 0.25% cut. So we'll have to see how some of the numbers in the next couple of weeks come out in terms of the wholesale inflation and the retail inflation numbers. And this is looking back to, July and, what the implied interest rate was. And the Fed did give us the 0.5% cut that everybody was expecting. So that was very good that they gave us that cut. But again, hopefully we get more cuts, which will give us the soft landing. I mean, the Fed is still trying to work out a soft landing. At this point, we'll see if they're able to get it done, but we'll know after the fact. But again, by year end, hopefully we have another one cut, and beginning of the year we have another cut. So we'll see what happens. And with that, we're going to hand it over to John to talk about the markets.
Sure. Thanks, Roy. So when we look at S&P 500 valuations, and we think about the overall valuation of the market, Paul started off the call talking about Groundhog Day, and probably over the last year or so, we've seen valuations quite a bit above what we would consider market averages. I know we don't have a chart comparing to the Magnificent Seven stocks or these AI stocks that we've talked about in quarters past, but certainly this new industry that's developed has created a bit of a bifurcation in valuations. We have a vast majority of the S&P 500 trading at relative multiples that coincide with a lot of the economic data that Paul brought up earlier in the call. And then we have some very large outsized corporations that are heavily involved in this high growth new technology that are supporting higher multiples, much higher multiples based on much higher projected growth, which creates, I think, a higher multiple at this point. It reminds me a little bit more of cycles past when we think about valuation. And this is also in relation to, as Roy just mentioned, rate cuts. I mean, the market has been anticipating these rate cuts for quite some time, and markets have moved forward over the last 24 months. The market is a forward-looking mechanism, and we've seen prices kind of maybe move a little bit forward of earnings in anticipation of these rate cuts as well. But I think the good news when we think of the multiple itself is that there's a lot of supportive overall growth in the underlying markets over the next 2 years that's justifying potentially this handle a bit. If we look at 2024 growth, we're looking at double-digit growth. Yardeni is got a 12.1% handle. Even when we look at consensus, it's 9.4, so it's right at about 10%. And we look forward to 2025, we're looking at 10 and 14% projected growth. So I think some of the future movement of the market is going to be a little bit of a prove it, where we have a lot of growth forecasts in certain segments of the market that are saying, hey, listen, we're going to grow at these extraordinary rates. And over the course of the next couple of quarters, I think we'll have to see some of these companies, what their actual earnings are and their shorter term projections, if they're in line with what we've seen over the last year and a half. And we're in earnings territory now. I mean, it's kind of interesting, maybe the call's a few days earlier. If it was a few days, maybe a week from now, we get quite a bit of some of these a lot of big companies this week, big technology companies going to be reporting starting tonight across the end of the week. It might give us a little bit of a look into the next couple of quarters to see how equity markets may react. And we'll see, but either way, I think a great highlight, we think of markets, is the bond market. I've been talking to clients, over the course of the last, call it 6 to 8 months. We went probably a good 15-year period where, when we think about an asset allocation model, bonds were ballast and bonds were a diversifier, but bonds really on a return basis were not really giving much of a positive return to investors. And as you can see in this chart, we're seeing double-digit and close to double-digit one-year returns. So we're finally starting to see some fruit in the bond market that is a component of markets moving off of what I would consider a zero bound, right? The Fed was zero bound for a long, long time, and we've had aggressive rate hikes in order to fight inflation, which sent interest rates up north of 5%. So now we're enjoying these 5% coupons, and we've seen a long-awaited normalization of the yield curve, where we've seen the Fed begin to cut rates, and we've seen bond yields react. If we move on to the next chart, interestingly enough, along with these great short-term rates that the Fed has provided, we've seen a spike in cash on the books. And that makes sense in some regards. You're able to get 5% on cash, zero risk investments. Talking about T-bills being able to get 5%. But we are, potentially now in a rate cut environment. I mean, as Roy mentioned, we're looking at 2.5 rate cuts, and if we go out even further, we're looking at maybe a Fed funds rate that might be down with somewhere along the lines of a 3 handle somewhere. So I think the expectation may be that there's going to be some cash that is going to be moving into both equities and the bond market. So I guess the cash is a bit of a, this chart is a bit of supportive of equity prices maybe being supported because cash has to find a place to be invested. And this should also be supportive of seeing cash maybe moving out the yield curve a bit into more traditional fixed income. And if we think about how traditional fixed income works when interest rates fall, this chart's a great chart to illustrate that. If you look at think of a 10-year Treasury is a great example. That every 1% drop that we see in yield, results in about a 10% return, a positive 10% return in the Treasury market. And that's what we've seen. That's why we're seeing a double-digit return. It's because we saw yields, I guess, probably peak at around, 5 and change when we think of Treasuries. And now they've, it's kind of settled in, in a 4 and change position. So at least over the course of the next, or the last year and a half, at least that portion of our asset allocation is giving us a pretty good return. And I think as we look out into 2025 and we see continued rate cuts from the Fed, no matter what we see from equity markets, and I think that remains to be seen what 2025 looks like after 2 really terrific years in the equity markets. I think we're set up for a continued solid pace of returns in the fixed income market, at least a lot more solid than what we've seen over the past 10 to 15 years. With that, I'm going to pass it over to my good friend Michael Williams, and he's going to talk a little bit about how these markets are going to react potentially over the next few weeks.
And thank you, John. And I appreciate getting left with probably the most politically heavy topic on the webcast today. So bear with me as I navigate through this minefield. But what we're going to talk about here in a minute is just kind of what happens around election cycles and what happens in the markets up and surrounding those. First and foremost, I just want to make the caveat that nothing that we discuss here is any sort of political statement. We as a firm take a stance that we do not see red or blue when it comes to politics. We only care about green, which is really, protecting and growing our clients' nest eggs in retirement. But just to kind of take a look at historically, and I hope the first thing that jumps out at you at this chart, and this is a chart going all the way back to President Kennedy, of the stock market returns based off whether it's a Democrat or Republican president. And the first thing I hope you take away from this is that markets tend to go up over time, regardless of who's in office, right? And we as a firm, in looking at kind of the historical narrative and kind of the return results, have taken a stance that really the president is just one piece of the puzzle of what moves markets. And there's so many other contributing factors. And I'm just going to point out one of the biggest ones in our eyes is if you look at the Bill Clinton era going into the W. Bush era. So during Bill Clinton's presidency, the market went up almost 210%. And a lot of that was driven by the tech bubble inflating, right? So back then, the internet was invented, which again, that wasn't by Bill Clinton. I think the whole joke is that was Al Gore who invented the internet. But the markets were just going bananas, for lack of a better word. So markets were going higher and higher and higher. And by the end of the Clinton era, he passed the reins to W. Bush, who took the brunt of the downturn of the tech wreck. W. Bush also had the 9/11 hitting. So that was a very volatile time in markets. And people also forget about this as well. But, Obama didn't start into office until 2009. So W. Bush got a lot of the downturn of the great financial crisis. And there's a lot of fingers that can be pointed at as to what caused the great financial crisis. But there's very little evidence to suggest that W. Bush's policies alone were what contributed to that, right? There was lax regulations, lax banking policies. People were not underwriting borrowers nearly as well as they should have. If you heard of those ninja loans where there's no income, no job, they were just writing these mortgages for astronomical amounts of money. And then they were getting packaged up, and the credit agencies were rating them AAA without doing a tremendous amount of diligence on those packages. But the bottom line is W. Bush's policies alone isn't what caused that. But again, his track record shows that downturn was on his record, right? And from now until the end of time, every politician who's in office, if the markets are doing well, they're going to say it's because of them. If the markets are doing poorly, they're going to say it's because of the guy before them. And that's just kind of a human nature and the nature of politics. A more recent example of kind of how the president is just one piece of the puzzle is, a lot of the recent, increase in the markets has been on the prospects of artificial intelligence. And, during Biden's term, I can tell you right now that Biden's policies didn't directly lead to the release of ChatGPT or any of these, kind of revolutionary things that are going on. Wasn't a direct result of President Biden's policies, right? So just, again, I know it's hard for a lot of investors and people to kind of separate themselves from themselves when you're looking at the presidential elections and what it could potentially mean for your portfolios. But again, we as a firm take a stance that it's just one piece of the puzzle. So if we go to the next slide, just as a thought experiment, this is a great chart that shows if you just invested per whatever political party, what would the results be? So if you were invested just during Republican eras, your annualized return would be a 2.79% return. During a Democrat president, it would be a 5.15% return. But lo and behold, the best outcome would be staying invested during all presidencies, whether it be Republican or Democrat, resulting in an 8.08% return. So again, this is not, we would never recommend someone kind of following any of their political leanings towards how they invest their money solely. But this is a good thought experiment just to show how important it is to stay invested regardless of who's in office. But if we go to the next chart, that being said, we would be remiss if we didn't acknowledge the level of volatility that's been in the markets and kind of coming into election. And this is somewhat normal for an election day, right? Or an election cycle. So as you can see, this is a reading of the VIX, which is a volatility index. Leading up to an election day, VIXs tend to spike to kind of somewhat all-time highs. And I'll say that this election cycle is nothing short of a circus relative to other ones when it comes to, former, assassination attempts on former presidents. We've had the incumbent president drop out of the Democratic Party for the re-election. So it's been a lot of volatility. Including this is all the escalations in the Middle East and everything that's going up. But typically after election day, when there's some sort of certainty about kind of what happened with the election, markets can kind of adjust and go higher, and the volatility does tend to recede. So as you see in the chart, leading up to election day, volatility index spikes and then continues to trend downward into the inauguration day, and then so on and so forth. So again, another thing that has to, or Paul, if you go to the next slide, another thing to acknowledge is that the president alone, again, is not what's going to dictate policy either, really. It depends on what's happening with Congress. And this might be a surprising chart for some. This is basically showing the performance of the S&P 500, whether it's a Democrat or Republican president, and then what happens with Congress, right? So that's another important factor. And actually, the best outcome for, in either case, whether it's Republican or Democrat president, is a divided Congress. And really what this comes down to in our eyes is that if you do have a divided Congress, you know that nothing extreme is going to get passed on either end of the aisle. And if there is some certainty that nothing's going to get done, even though it can be frustrating as a citizen, from a business owner standpoint, it's actually a good thing, because then you have some certainty about what the future holds, and you can actually start to run your business accordingly, right? So that's kind of the big takeaways for us, is that it's not just who the president is, it matters what happens in Congress. And it's important to remember that you're also, what stocks are, is you're buying little slices of businesses, right? And I can tell you, whoever is in office, whether it's Republican or Democrat, companies like Google, Microsoft, Tesla, all those companies are not going to they're not going to stop trying to make money regardless of who's in office. So again, our firm policy, and we're trying to relay this to clients as much as possible, is try not to let the craziness of the elections kind of dictate what you're doing with your portfolios or your retirement savings. Because, at the end of the day, and we've seen this, whether it be the first time or when President Trump was elected the first time, or when, Joe Biden was elected, people get very emotional and decide to get very conservative, thinking that this is going to move the markets in one way or the other. And in either case, that was a bad decision. So, again, we just would recommend just trying to take everything in stride and just know that this volatility and this election cycle will pass at some point, and hopefully markets will move higher after the volatility is done. So with that, Paul, do you mind flipping the next slide? We want to thank you guys for joining us. Just as a reminder, if you do have any questions, please email those in to pwm@prestigewmg.com. And please be on the lookout for the replay of today's webcast, which will be sent out in the near term. With that, we want to thank you again.